Talking with Traders. I'm Dan, and today my guest is a good friend of mine and one of the most interesting traders I know, Rob Smith, the inventor of the STRAT. Rob, thanks for being here today.
Hey, my pleasure, Dan. I always like to hang out with you, whether it's virtual or real.
For sure, man. And it's great to have some video this time so we can see you and see your impressive monitors. I mean, that's a lot of screens. A lot of traders aspire to have that kind of setup.
Well, and some people will be like, you don't need all that. I'm like, but when you're set up to track stuff, it's a lot easier than changing a lot of layouts. So I've got 16, 27-inch monitors. That means you don't have to change layouts as much, and it's just easier.
Yeah, I remember when I stopped by your office, you were like, you could point at a screen, right, and be like, this stock is in this window on that screen. I was just blown away. I don't even remember what I had for breakfast today.
That's part of it. When you have that many screens, you got to know exactly where everything is, because anybody could put up a million charts. But if you got to be like, where's that? But it's years and years of making sure it's always in the same spot. These are the Dow Jonesers. This is the time, all that kind of stuff.
So Rob, you've got a great backstory. So I wanted to ask you. So those watching us here today could hear this. How'd you get into trading? What brought you to this world?
Basically, my father, and he was a trader from the 1950s into the 1980s. And so he ran Merrill Lynch Institutional on the CBOE in the 1970s, like right when it started. And so when I got to high school, he's like, why don't you come down to trading floor? So 41 years ago in August, I started working in the summers on the CBOE and checking it out. And I was like, this is cool. And everybody's having a good time. And then every summer through high school and college, I would work down Chicago Stock Exchange until I finally went full time. And the thing about it was I had no idea what's going on down there, right? It's just a bunch of fun guys and people and stuff. And so I'm like, all right. In Chicago, growing up, everyone knows somebody who's involved in the markets, pretty much.
Absolutely.
Right? And so and they always associate them with rich guys too. And I'm like, this is great. Where do they hand out all the money down here? It's like, not how it works. And I was like, what? And so I started working for a specialist, a friend of my dad's, because nepotism was all the thing. Your son works for me, my son works for you for a while, and you get to feel it. And so the guy I started working for was a position trader.
Okay.
And so he would take these big positions, trade around the order flow, but he would lose money like 20 days out of the month. But when he did, it was like, boom, okay, cover everything. And so that's kind of where I was learning from. And so I just got married. I was clerking for him, started trading, and back in those days, computers just started hitting the floor. Like there's barely any computers. And so we had one, and we had this S&P up there. And the specialist next to us was a specialist in compact computers. Well, back in those days, we were talking about someday everybody's going to have a personal computer. And I'm like, this is going to be big stuff, right? So compact computer, I couldn't even say CPQ for years. It was running up. And 80, 90, 100. I'm like, wow, man, this thing's cruising. 120. I'm like, yeah, I'll buy a compact. This thing's going to the moon. It's never going down. And the guy I was working for is like, yeah, let's get in there. And so the next day I come in, and on the screens, I used to have an opening indication. There wasn't any after hours, right? And so it's flashing on my buddy's screen next to me. He was the specialist compact. That's how I got into it. And it's showing 80, 90. And I'm like, what does that mean? He's like, that's the indication. I'm like, it's opening between 80 and 90? That's going to be down $30? I'm like, oh, man. I'm like, all right. So it opens. And Jim, being the position trader type of guy that he is, the guy I was working for, he's like, well, we can just buy a little bit more down here. And I'm like, yeah, screw him. Yeah. By the time I blew this thing out, it was at 36. I lost almost everything I already had, and I haven't really even started.
Oh, God.
And so that was a real wake-up call. And so Harvey is the other guy with the compact specialist, and he's the one that had the computer. And he's calling like chart patterns. I'm like, how do you know what that is? And he's like, they have books on it. And I walked across the street. I was like, do you have books on technical analysis? I'm like, yeah. I'm like, I'll take them all. And I was like, I'm going to figure this thing out if it kills me. All right. And I read them all. I'd summarize them all. And I'd go through everything. And I would still struggle with it. Most of the books would have an asterisk. Well, nothing works in all markets. I'm like, well, well, how am I supposed to know what to do then, right? And so what I did was, because of all my work, I later worked with Harvey, who's the specialist in compact, and I originally had 8 screens in 1990. And so from then, what I would do is at night, and at those times I would do it in the morning and on the weekends, I would make sure that I went through every stock in the S&P 500 and any other big stock, monthly, weekly, daily, 60-minute. And I wouldn't try and totally analyze it, like, like head and shoulders or anything like that. I was like, my mind's just got to see it. I mean, something's going to jump out at me someday, right? And the most important thing in those days to me was just going with the relative strength and weakness. I'm like, this thing's strong today, these things are weak. We still do that, right?
Yeah.
And that served me well for a long time, but I didn't really have a precise strategy. I knew to do that, and that's good, but I would still see things, because when I started, they'd say, I'm like, what's a good year? I'm like, 10%, 15% is a good year, 20, 30, boy. And I was like, there's stocks that do that every day. I'm like, yeah, it'll be right once a year. And I would look at the percentage gainers and all that kind of stuff. And then over time, I was like, I just want to see what does something look like before it does it, where you'll see guys being like, oh, that's way overbought. I hope it keeps going so I can short it. Or that's getting killed. Like, I hope it keeps going down so I can get the bounce. I'm like, well, wouldn't you want to get it before it starts doing that and catch that whole thing?
Yeah.
Right. And so I just started continually doing that. And then just about 10 years ago, I started putting the pieces together of the STRAT, where on a Fed day, I was noticing how back in the day, Fed days used to be a lot more volatile than they are now. And so what would happen was, the crisis is going on, so they're cutting rates, and we know that's coming, right? And so what would happen, this is where I picked up on the broadening formations, was that it was a Fed day, and the news was discernibly good, right? They had cut rates more than we were expecting. And what happened was it spiked up, price spiked up, then dropped, and then went to the moon. And I was like, that doesn't make any sense. Why would that happen like that? I was like, if it's good, it should just go up. And that's when I saw it forms a broadening formation when you do that, right? And so the reason that happens is that when you have a group of people trading and watching the same thing and absorbing the same news at the same time, here's what happens. Here's why that happens.
The psychology.
It's also an order vacuum is created. So what I mean by that is that everybody's sitting there like this. I'm like, good news, buy. Bad news, sell. You ready? Good news, boom, buy. And so everybody buys it up, right? So they create an order vacuum. There's nothing back down. The first guy that takes profits, there's nothing there. So it comes screaming back down. Then you get the guys who held off and say, if it goes down on good news, that's worse. So when it comes back to the price where that announcement came out, you have guys slamming it then and really bringing it down. Now, when it comes down here and they go to cover or new buyers come in, now the order vacuum's twice as big. You just wiped out all of that, right?
Yeah.
So it's probably something
cleared out the supply and demand.
Right. And so then it goes rocketing back up. And I was like, okay. So I know, so I figured if that happens, and I see the broadening formation, I was like, and I went to the books and like every book's like, that's rare, that's rare, that's rare. And I started drawing back on everything that I saw. I'm like, these things are in everything. Like this is how it works. Because everybody's got it backwards.
And you're right. Everybody does draw wedges, right? It's always a contracting pattern that you see on almost every chart. I'm guilty of this myself. I mean, mine are primarily falling wedges, right?
Well, that's why when you use multiple time frame analysis, when something tightens on a longer time frame, it's going to form an inside bar.
So, let's talk about those. What's a 1, what's a 2, and what's a 3?
Okay, so it's important to understand when you look at a chart from one bar to the next, there's only 3 possible outcomes, right? And so that's why we call them a scenario 1, a 2, and a 3. So a 1 means consolidation, an inside bar. You weren't strong enough to take out a high or weak enough to take out the low, right?
And when you measure this, you measure from the high to the low, right?
Yes, and some people ask me, do you use the wicks? And I'm like, yes. And when some people say we only use the real bodies, I'm like, well, that doesn't count. I'm like, I just got stopped out up there. That counts to me. All right. So it's definitely traded there. That matters. So it has to be completely inside. And that's equilibrium, right? The buyers and sellers know there might be a bias. It could be a big inside bar, whatever, green or red, but it still didn't do it, right? So what that means, the buying and selling is equalized and formed an equilibrium, right? Somebody's got to take that eventually,
Yep.
right?
And on a lower time frame, that's your wedge.
Right. So like today, S&P SPY's inside day, whole bunch of inside days today, whole bunch of ones, right? And that's why you avoid trading that, because you're going to get chopped up. It's not doing anything. So you can see how the SPY chopped around the last 2 days, right? Essentially, after the second hour yesterday, we haven't gotten out of the second hour of range in the S&P since yesterday, right? And you can expect to get killed in there, right? You want that to form, that inside day to form. You're gonna see something different tomorrow, all right? So that's a 1. Scenario 2 is you take out one side of the previous bar. Okay, either the high or the low, right? So you open here inside, or you gap, but you take out the high or you take out the low. Okay, that's a 2. That can be defined as trend, right? It's definitely taking out the high and it's definitely taking out the low, right? So it's a higher high or a lower low.
Yep.
Scenario 3 is very important because, like I said, books on technical analysis tell you broadening formations are rare. Scenario 3, you take out both sides of the range. And the important part about that is how that helps you gauge magnitude. It also tells you that buyers and sellers are aggressive. And the way you know that, they were willing to pay up and they're willing to sell down, right? Both sides are very aggressive. And that's where you can get the wilder moves, watching that kind of stuff. So the important sequence to remember is a 1 will go 2, has to eventually, right? And a 2 can either stay 2 or go 3, but you can't have a 3 unless you go 2 first. So it's very important to understand that, because once you understand that a 2 is failing and coming back through, then you have your magnitude. You're going to go out and take out the lows.
It makes sense. So in a 3-1-2, we're in Chicago. For those who aren't from Chicago, Rob and I are. So 312 is our area code here, and it's very dear to us, people from Chicago here. But in a 3-1-2, then you have an outside bar, right, which is a period of volatility where it is wider than the previous bar. Then you have a completely inside bar to that outside bar, right? And then it breaks one way or the other, right? A 2 up or a 2 down.
Right, and then has the magnitude of taking out the highs or lows of that 3. And the reason that works, most importantly, is understanding the reason that these things work, right? There's rationale, and once you understand that, it makes total sense. So oftentimes I'll use an analogy like this. This is what happens during a 3-1-2, right? It's like kids on the playground, right? And we start fighting, right? And we're both blowing each other pretty hard, right? And then to say, all right, we've had enough, and be like, I know, you go get your people and I'll go get my people and I'll meet you back here tomorrow, all right? That's your equilibrium, all right? Overnight, now we're even, we've at a standoff. Now, because we're both aggressive, really aggressive, willing to take out the highs and the lows, we come back and we see who's got more guns. It's like, you show up with your brother and your uncle, and I show up with tanks and guns and planes. I'm like, guess who's gonna win this one, right? That's exactly what happens, right? So it's, I'm willing to pay up, I'm willing to sell down. How much size do you have? I'm like, it's like, I got 400 shares. I'm like, I got 250,000 shares to buy. Boom, now it goes.
That makes sense. And I think you touch on an important point there, because when you're trading the strat, you want to trade in force, right? So you want to catch the 2 when it breaks the 1 before it, right?
Correct. And when we talk, because you want to use the other participants to drive your price, right? So what I mean by that is that when we get into time frame continuity, that a lot of people will be incorrect by saying algorithms are picking me off. They're actually very stupid. You can see exactly what they're doing if you know what to look for, because it's a convenient excuse for people getting stopped out. When you think about it, why on earth would anybody have an algorithm that comes down, stops you out, and then goes back the other way? It wouldn't make any money, right? it just wouldn't, right?
Yeah.
It seems like it, but you're just a victim of price discovery. Now, when you have, when we know that, say, 70 or more % is now algorithmic automated trading, people think of evil robots. It's not, because it's very simple to see them, because you have to tell a program 3 things. What do you want it to do, buy or sell? when do you want it to do it, and how do you want to do it by staying on the bid or taking the offer, right? You have to tell it those three things, right? So when we combine time frame continuity, and I can get into that in a second, and that's all time frames are green on a monthly, a weekly, a daily, and a 60, and we can use different time frames for volatility, but we use those as our basic group. When all that is green and we know automated trading exists, we know exactly what they told them. They told them to buy, they told them to do it now, and they told them to take the offer. There's no other explanation for that. That has to be occurring. And so once
I think you're probably very spot on about that. I've heard, I mean, look, man, I take a lot of support calls, so I talk to a lot of traders, right? And I hear things like the algos are picking me off, the market maker is screwing me, right? There's all these different excuses, right, that people give for their losers, and it's an interesting thing, right? They take full credit for their winners, but the loss is because of an algo or the market maker or somebody. I think people need to get over that and just understand that this is math.
Right, this is how it works. It's like, because when people see that, it's exactly what I'm telling you about broadening formations. It's like ranges will tend to contract and expand, right? And they won't do that just once. They'll go back and forth, right?
Yep. So price discovery.
Right, price discovery. And so when it appears that they came down and took you out and back the other way, there was just discovering down there, there's nothing there except you. So then it goes back, tests the other highs. And so a lot of times people will trade and see it like a tighter range, and they'll start making money a little bit here and there and whatever they're trading. And they get a little more confident because the range is fairly the same. And then as soon as it grows, they give it all back and then some. Right? A lot of traders have that problem. I make a little, give it back and then some. So what we do is we reverse that, especially because it's much easier with a lot of people having low or zero commissions. We don't care about getting stopped out. We know that's going to happen. But when you trade using the time frame continuity and the setups that you have on TrendSpider, my STRAT setups, it's kind of like home run derby in baseball. It's like we might have some foul balls, but when you get a hold of one, it's gone, right? It's gone. And that's where you get those big three candles. You fail one side and you come ripping back through. And when that occurs matters. A lot of people don't focus on that. They'll just look at their chart and they don't look at the bottom part. I'm like, well, if it breaks over my level, I'm going to buy it. I'm like, you're going to do that if the Fed's coming in 5 minutes? You're going to come do that on Friday with 45 minutes to go? Are you going to do that? All that kind of sequence matters when this is going to occur.
Yep. I agree. I think a lot of people lose sight of that. You talked a little bit about price discovery, right? And this is a term that I don't think many traders have wrapped their heads around, right? But it really, if you think about it, is the product, right? It's the benefit to society that trading provides that I don't think a lot of people understand. Can you talk a little bit about that?
Yeah. So anybody who will trade like horizontal levels that they believe are a horizontal level will know what I'm talking about. More oftentimes, right? If you traded the failure of that breakout, you would have made more as opposed to taking the actual break, right? And so good guys will say, well, if it doesn't go, I'm getting out of the way. I just get out, right? But more often than not, then it comes screaming back through and going back through the range. So especially when you have horizontal lines, because it's almost never horizontal. The lines are, but the price never is. Yeah. Right? If you really look at it, it's like, well, that's 20 cents higher. I'm like, that's 20 cents higher, right? And so I'm like, well, that's my resistance level. I'm like, so you believe that there are sell orders defending the old high? It's like, that's not true. There's buy orders there because there's stop orders there, right? And so that's another way that the price discovery works, is that people will say, look, it's coming down to my level, whatever it is, 36 or whatever, right? And you can have 5 different guys being like, oh, that's 36, that's support, oh, that's it. I'm like, where'd you buy? 36.50, I bought some at 36.20. What about you? 36.75, we'll see if it holds. 36.10. Hey, everybody, where's your stop? All together, 35.99, right? And so boom, takes them out. And like I said, takes them out. And then there's an order vacuum from them that brings you back into the range. And so people have held off, say, now it's reclaimed, now we can buy it back, right? And so that's a lot of the mechanics of understanding what's going on.
I've been in those situations, so like I will freely admit that I have absolutely fallen for that.
Right.
Plenty. I think and everybody has.
That's why we
Understand what?
look, right? And that's why we look for setups to do that. It's like when people say, this is my pivot, I'm like, we're waiting for one of our setups that will trigger that. We don't have to do it ourselves. We use other participants to trigger it to see how far it's going to go.
It's fascinating.
It's fun because what we also call, you want to be coming back through a previous range as opposed to going into new highs or new lows. And the reason you want to do that is for those pivots, we call it pivot machine gun. And the reason the price will speed up, the aggregation series will speed up when it happens, is when you fail the bottom of a range or start coming back through, right? And continuity changes. You have the computers buying. They're told to buy and take the offer. Now, because you're coming back through a previous range with a whole bunch of pivots in places that people are short, what will happen is that they're triggering stops, which is removing liquidity, which makes it even worse, right? So these guys are going, where's the stock? Where's the stock? And so then once you go back into the new highs, we call that exhaustion risk because the buyers have to step up. You're not going to have any more help. Anybody who's short is blown out. They've got nothing to be short against, right?
You know, man, I see this all the time nowadays, right? You see the broadening happen on every time frame, right? You see it happen on long time frames and short time frames, right? And you
look at
a
monthly spike. I mean, how
exactly.
You missed that as a giant.
Exactly, right. It's actually there's multiple broadening formations in SPY, right? Like if you look back, it's happened and it happened. It's probably going to keep on happening, right?
Right, and that's why like, oh, it's a new type of market. I'm like, no, there's nothing new under the sun, man. If you go back in time, I was born in 1964, and there was a broadening formation from 1964 to the year I graduated high school, 1983. If you go take a look, it's a doozy.
Wow, I will take a look at that. Okay, so you know, I think we've covered you know the three different candle patterns. We've talked a little bit about broadening formations. The last thing, and you touched on it a little bit, but this idea of full time frame continuity.
Yeah.
This is something that's important to you. Maybe you can just help people understand what exactly that means.
Okay, definitely. So what we want to do, as opposed to using a moving average, we say if it's above, that's bullish, or below, that's bearish, because we know that if that would be simple. And we also know that we just got destroyed from over the 200-day moving average. We also just had a monster rally below the 200-day moving average.
Yep.
So if that doesn't discount it right there. What time frame continuity does is tells us what the participation groups are doing by price and time. So if you go and you look at where this rally came from, it started in the second quarter, right? That's a new quarter with a new month. And so if you look at that, all the time frames flipped green into the second quarter. So we knew right there that we're buyers, right? Conversely, when we started tanking Feb, March, time frame continuity was the downside, which means that the computers were told to hit the bid, and people are hitting the bid. The price is going to drop. And so if you don't understand that, what you're going to do is you're going to get in front of a freight train and say, oh, this is my level and I'm going to buy it. I'm like, you're going to buy it while everybody's hitting the bid. Do you think that's going to work? No. Right. And so the time frame changes. And so you'll see this on a 60-minute chart, right? And this is why we call the bottom of the hour the flip. It's like a new day to us, right? Are they still buying or are they selling? Are they taking profits? What are they doing? Especially the higher the volatility. Because when the volatility is high, the 60 can be like a day or a week, a normal day or a week.
It can be, yeah.
And so we'll break that down to 30, 15, 5 minute, 3 minute, and 1 minute, right? When things are really moving. Not everyone's going to be that fast. But it's important to understand that price doesn't move, it aggregates. And so when you use oscillators and stuff like that, you're on the premise that it follows the laws of physics. But it's not an object, it's an aggregation series. You have to have a seller for every buyer and a buyer for every seller. So it's not that there's more buyers than sellers, it's who's more aggressive, who's getting their price. And so when you look at multiple time frame analysis and you see it's all green, the sellers are getting their price because the buyers are taking the offer. That's what they told them to do. And it makes it even more obvious now that we know that it's automated trading because they have to turn it off, right? Or just let it run. And then when you come back through, like I said, that series and be like, how can you come from a low, right, down in here and come up here? You know, if you're using oscillators, you're down below your moving averages and all that thing. And you're like, oh, it's a breakdown to the lows. Now, if you use time frame continuity and you got a new quarter and a new month and a new week and a new day and that's all green, now you caught it early right here all the way through, right?
And that makes sense, right? So if you boil it down into its most basic terms, it would be just in 4 or 5 separate time frames, the current price being above the open.
That's right, above the opening, because you'll hear a lot of people say if it closes above this, that's bullish. It's irrelevant to the next price.
Just where it's trading relative to where it opened.
Yes, you want to watch opening prices because that tells you, are they aggregating on the offer or the bid from the opening? That's what I want to know about. So when you'll hear CNBC like, it's the most important hour of the day to close. I'm like, well, that's the most important hour of the day to your P&L, but it's not the most important hour of the day to what's going to happen in the future.
So on like a daily candle, right? I just want to make sure I get this right. You would be watching the very open. You'd be watching the order book, and if the second the market opens, they start smacking the ask, right? Then you're bullish, essentially.
Yep. And then so we have a thing called uncoupling. All right.
Okay.
And so we gain more information as time goes on, because if let's say that the month starts on a Monday, the first hour, the 60 daily, weekly, and the monthly, the same opening, right? So it doesn't mean we don't trade. We just don't have as much information. Second hour, the 60 uncouples from the day, week, and month.
Okay.
On Tuesday, right? If this is the earliest, let's say that the month is already open, right? On Tuesday, on the opening, the 60 and the daily are the same for the first hour. But after that, we have 4 separate openings. Now we can identify participation groups by price and time, all 4. That becomes more important to us. So as time goes on, the sequence also works like this. Everybody's heard of Turnaround Tuesday.
Yep.
All that is negating Monday's openings, what that's doing, and giving you a scenario reversal, right? We know about that, but that happens all the time. That happens from hour to hour. That happens from 5 minutes to 5 minutes. It all happens from week to week. So when you hear guys talking about, well, what do you like for next week? I'm like, on the weekends, the only signals that you have in force are monthly, and then the potential weekly, daily, and 60s, right? Now you can have a bias because you're closer to doing those or reconfirming the month, but the second week is going to reconfirm what the first week did, or it's going to negate it, right? Or neutralize it by going inside. So it's a constant series of that, and understanding that there is a sequence like this. So this is this is going to be the end of the second quarter coming up. We got a new quarter coming up, right?
We do.
And a lot of things are going to be inside quarter ones, but they're monster green, right? And so when you look at stuff like that, the only important thing about the close is what we say is, what's the next 2? You always want to know, what is your next 2? Are you anywhere near it? And what I mean by that is, when you have like a long green bar like this and it closes out, how are you going to 2 down, right? If you're nowhere near that, how are you going to do that, right? You did have to gap up and go 3, go back inside, or really get killed, but you're nowhere near that. So when you look at stuff on monthlies, we're going to look like that to reconfirm to the upside. Like if you look at LRCX as an inside month to the upside. If you look, and the sequence was very clear. If you look at what happened when the market got smashed, it was an outside bar on the monthly S&P.
Yep.
And continued 2 down, right? And then what happened? Then we changed the quarter and the month and went green and came up. And at that point, people are trying to buy the most oversold. Wrong answer. You want to buy monthly 2s that took out March's highs, right? That was Amazon and W, and they screamed. Then the S&P went inside, right? Inside month, and we took it to the upside this month. And a lot of things did that, like WIX and all that kind of stuff, or last month, I'm sorry.
Yep.
So understanding that that's all going on, and people are like, I think it's going to roll over. I'm like, we are nowhere near any of those openings. Like when we started going on the monthly, the inside month in the new quarter in April, people are like, I think it's going to roll over. I'm like, we're nowhere near a 2 down in here. Nowhere near it. I'm like, you're going to have to at least get it on a weekly first. And if you didn't keep getting that, market's not going down.
Fascinating. Well, there you have it, folks. That's the STRAT, which is honestly, I don't say this about most trading strategies, but this actually makes a lot of sense. Rob, thank you for being here. I'll leave you with one question before we end this, because I know we're running low on time. What advice would you give to a completely brand new trader, somebody looking to just get into trading and doesn't know, a whole lot about it? What would you tell a person do that?
Here's what I would say. It's like, I've been doing this 31 years, and I've done my homework in it for 31 years. And what I've seen is that I would prefer that you have never traded to come talk to me. I would prefer that because I don't have to wipe your brain of everything that doesn't work. Because I'm gonna tell you right now that anybody who's been in this business will tell you the attrition rate of traders is extremely high. Of people who look to try and trade, maybe 90% of people who want to trade for a living blow out and don't make it.
The stat I've heard is 90% of new traders lose 90% of their money within the first 90 days of their first trade, right?
Therefore, why are people still using indicators and all the things that have proven not to work? Because if everybody's been using the same thing since I've been here, relative strength, stochastics, head and shoulders, since I've been 30 years that people have been doing that. And this is the attrition rate. Why would you even go down that path? You're a definite loser, right? What I'm telling you is that there is nothing else but 1, 2, 3 in time frame continuity. This puzzle's been figured out, right? It's not always going to be easy because the threes can make it tough, but you always know what's going on. And so one of the great things about trading our way, calm as Hindu cows, not a lot of stress and key banging. We know exactly what's going on. Where's it going? Up there. How come? Because that. It's like, should we buy it? Right there. And it's very cut and dry. So I would definitely say, come talk to me.
I love it. Folks, if you're watching, if you're skeptical, Rob's the real deal, right? I've been to that office. Those monitors are real, right? He really knows his stuff. His dad's old vest from the CME, right?
Yeah, he was at CBOE.
Oh, CBOE, right? It's hanging on the wall, right? So I have a huge amount of respect for Rob. And Rob, thank you so much for being here. I mean, it's always a pleasure to have you. I wanted you here today because a lot of our traders just want to learn more about the strat, right? And, distilling it down like we did today, hopefully will help them do that. So thank you again.
All right. Thanks, Dan. It was good to see you.